Hello. Hope you had a lovely weekend. You're probably watching us on a Monday. If you watched us on Friday, you would have noted that Tinashe got rather excited about...
He had bees in his bottom, literally. He was jumping up and down.
Because he was drinking that sugary stuff. About a thing that he called risk neutrality when it comes to inflation and currency devaluation. And if you missed the episode, basically the gist of it is we're trying to figure out what the average person should do in the context of an increase in global inflation. Tinashe, would you like to lay out your argument in a cool and calm manner?
We'll let you pontificate.
Okay. So in simple terms, everybody already takes a part of risk that they're already comfortable with, right? They've calculated it and they said, okay, this is the sort of risk I'm willing to take. And when you look at currency, which is what we're taking, is almost every fund manager, or everybody, in fact, has taken on the currency risk, the US dollar currency risk. When we say that the US dollar is a reserve currency, it means that the international world has actually taken risk on the dollar, right? So they said, you know what, if we're trading, so Zimbabwe exports are $5.2 to $5.7 billion, and we import 5.7, but the currency or trade doesn't matter whether the product is going to China or is going to the UAE or it's going anywhere in the world. It's done in US dollars. And 88% of international trade actually happens in the dollar. And the reason why it's happening in the dollar is because people are comfortable with that dollar risk. So even if there is inflation on the dollar, people are already saying, but I'm comfortable with it, even if it's 7%, right? Over the longer term, over a 10 to 20 year period, I'm comfortable with that risk because it will go up, it will come down. I'm comfortable with that risk. That's what I meant by risk neutrality. So similarly with investments, that when people have taken on the US dollar risk, they're taking on a level of risk that they can calculate and they're comfortable with. The problem happens when you're saying to hedge that risk, right? Go into a commodity that will outperform inflation. And then the commodity that you guys are choosing, so even if it's gold, you're still taking a risk there, or any other. It could be oil, it could be whatever other commodity that you're getting into. If we look at the volatility of those commodities over a 10-year period, you'll actually see that you're adding on more risk than the US dollar risk. So risk neutrality doesn't mean you're not losing, but you're saying, I'm comfortable with the loss. That's all I'm saying. I'm comfortable over a longer period of time, I'm comfortable with the loss. And then when you asked, so what should you do? And if you have excess US dollar, you're not going to switch into commodities, or if you want to be risk neutral, is you're just going to buy more treasury, more US dollars. And yes, it's true that the yield right now is fundamentally less than the inflation rate, but that will not always be true over a 10-year period. And I'm not even a fan of the Fed. I'm not a fan of the Fed at all. But we're saying over a longer period of time, of 10, 20 years, the Fed has kept more positive interest than it has negative interest. This is not the euro, where you're actually saying, don't bet on the euro, don't bet on Japan, move out of Japan, move out of the euro, because we're hardly going to see positive interest rates. But I think the Fed, even after 1 year of inflation, think about it, 1 year of inflation, they're coming in and saying, well, we're going to correct that. We're going to increase our interest rates. They're the only ones,
that's
actually.
fantastic. They let us lose money for a year before they stepped in.
Okay. You are losing money. So risk neutrality doesn't mean that you are not losing money. You are losing money, but you're saying it's the risk I'm comfortable with over a long period of time.
Yeah, so I think there's something that you got wrong on the show when you were characterizing my argument.
Okay.
So I'm not a big fan of commodities, by the way, as an alternative to fiat currency or to
That's
the
why
US
I was
dollar.
surprised.
Okay,
I know this.
I agree with you that they're very volatile and that some of them can go for long periods of time, actually underperforming treasuries and inflation. Because what happens is when the price of a particular commodity is quite high, you see massive investment in that space, and the supply changes, and it can depress the price for a decade or more.
Boom and bust.
Exactly. But I'm still not a fan of treasuries, because if you look at, so seeing as we're talking about the reserve currency, if you look at the US economy over the last 200 years, okay, it's averaged 1.5 to 2% GDP growth over that period. And if you look at the S&P 500 over the last 100 years, it's outperformed treasuries, right? That's what Warren Buffett keeps arguing, that if you want to save, don't go to a money manager wearing a slick Ralph Lauren suit telling you that they can return the world. Just buy the index. And over the long term, you're going to outperform inflation, you're going to outperform the US dollar.
Can you explain a little bit about buying the index?
So basically, if you look at any capital market, so I'll start with Zimbabwe. Okay, the Zimbabwe Stock Exchange. There's what is called the industrial index, and it's basically the prices of a bunch of shares that are listed on the Zimbabwe Stock Exchange, weighted in a particular way to form an index, right? And unfortunately, okay, in Zim we don't have a fund that reflects the index, but we do have.
No, we've got ETFs now.
We've got an ETF, we've got the Old Mutual ETF, and we've got the Morgan and Co ETF. And it's basically a basket of stocks that are blue chips that, to a large extent, actually reflect the index. In more sophisticated global markets, what you have is, like in the US market, you've got the Standard & Poor 500. And Standard & Poor is basically a research house, and they put together a portfolio of 500 companies that meet certain criteria. And you can actually, if you have $1 in savings, you can actually invest $1 into that index. And you can hold on to that investment over a very long period of time. And that's, the S&P 500 is considered a benchmark. That's how anybody in the money management business in that part of the world, that's how their performance is measured. Are you outperforming or underperforming the benchmark, the S&P 500, or whatever the particular index is? And sadly, the money management industry, for the most part, is a fraud, because more than 90% of fund managers globally.
Wait, don't you work in it?
No, I'm on the sell side. I'm not on the buy side
Of the same industry.
of the same industry. So I'm not.
So you work in the industry.
I work in it.
So this is a guy in the industry telling us it's a fraud. He wants a guy who doesn't know anything about these things to put their money.
No. So hear me out. Let me make my point.
Okay.
You're taking a long time to get there.
90% of fund managers globally underperform the index. And Warren Buffett actually 2 years ago had a famous bet with one of these fund managers. And he said, listen, I think you are an individual investor is better off just buying the index and not handpicking George or Tinashe or Rufaro as their personal portfolio manager. And he said, well, look, that's my business. I'm a money manager. I will outperform the index. And they bet a bunch of money over a 10-year period where Warren Buffett said he would underperform the S&P 500. And this particular fund manager bet the other way. And Warren actually won that bet. And that's, like, statistically...
Isn't Warren Buffett a money manager himself?
No, he runs a conglomerate that manages a bunch of money. It's different. But he won this bet. And to be fair to Warren Buffett, by the way, Berkshire Hathaway, the company that he's the chairman and CEO of, over the last 30 years, has outperformed the benchmarks. Any benchmark?
So I'm not an investment manager, so I can't give that sort of advice. But as an economist, all I can tell you is when you look at trade, international trade, a lot more people take risk in themselves in whatever business that they're into. And that's where they take the risk. So when you say inflation, what's more likely to happen is that they just increase their prices. So how they counteract that inflation risk that you're talking about, as far as they're concerned, it's something that they can deal
But
with.
their savings. The point I want to make, and I want to be very clear, is if you have $1 in savings, right, and you have the option of buying a US Treasury or buying an index like the S&P 500, I believe you're always better off buying the index in equities instead of treasuries.
If the dollar is in
And
investments.
so
But if the dollar, so keep this in mind. If you're an entrepreneur, and that's the difference between you and I, is that you're an investment manager. I'm an entrepreneur.
I'm not an investment manager. It's like he's not an accountant, but anyway, that's a different argument.
But as an entrepreneur, if there's inflation, the first thing I do is I just increase my prices. I just pass it on to the consumer.
But what do you do with your dividends?
Just wait a moment. So I pass it on to the consumer.
If you can.
Most can. That's why you're in business. The idea is to continuously pass it on to the consumer, right? And I am inflation
You must
neutral.
have worked for Delta at some stage in your life. Did I say that?
Well, most businesses, that's what they do. They pass it on to...
I'm a Delta fan. I'm drinking a Delta product, and he's not really my friend.
The world that you speak of, most people are not interested in that world. They're actually not. That's why that risk, that level
That
of
might
risk...
help to explain why most people are poor.
Well, you're talking about... So
I'm
look
being
at...
cheeky
Look
by
at
the way.
You guys are getting lost here.
Yeah.
Okay, so you're saying stocks versus cash or near cash. You're saying, well, most people who have anything to save are invested in themselves.
They invested in their businesses,
But
in their...
and then
they're not interested.
My question
in-
to you is, what about those that are not entrepreneurs? People that are employees and have their extra $50 a month they'd like to save.
Again, that's where I would agree with you, that go into a real asset that you use. So don't go into an asset that you don't use, but you're saying, okay, over a longer period of time.
So if an employee saves $50 a week and they use whiskey, they should buy whiskey. Is that what you're saying?
No.
No, actually, well,
No.
in a way, it is what you're saying. You're saying if I can buy next year's whiskey now, I'm better off.
You are better off. Something that you already use. So you are already an alcoholic, and your money is losing value, and you know that you're going to be drinking for the next 20 years. Then you might as well buy the product, right? So that's where the risk neutrality is. You're always going to drink whatever it is, even in 20 years' time, I assume, if you're still alive.
That's rather dark.
Well, those are the consequences of...
live sad, die happy. I don't know. I'm
So,
gonna
so
die.
you are neutral in the sense that you still be
Well, they say
consuming.
the good die young.
Well, there's that too. But in 20 years' time, you're still perfectly fine because you're like, you know what? There's that year when there was inflation, and instead of taking my $50 and going onto the stock market or going into a TB or whatever, I actually bought something that I actually thoroughly enjoy, and
I'm
I
still
built
enjoying
my...
it.
I still enjoy it, and 20
And I got it
years,
cheap. Okay.
you know. So you're
But,
neutral.
but I think you guys agree on that.
You are neutral.
So why was he jumping up and down and
no,
losing?
because you just didn't.
No, it's the
listen.
sugar. It's the sugar.
You didn't
and
listen
it's-
to my argument.
And it's the lack of color in his pants.
No,
Okay.
you
we
just
need to
didn't-
regulate this man more.
You didn't listen to my
Sasha,
argument because
I'm sorry that I ever make fun of your pink pants. Please
Although
wear them
you are
whatever you like.
wearing rather pink pants.
Well, the camera can't see them.
and I'm saying
And
there are
maybe
lots
that's why
of
I'm in a sunny
okay.
mood.
So let me ask you a question. There are lots of fund managers that are in dollars. They cannot invest in anything other than dollars, and a lot of them are from trade. You know, a lot of people who trade, whether you're Chinese or whatever, and you're saying, I don't want to take stock market risk. I don't want to take any other risk, but I'm giving a fund manager who is purely in dollar. If you're that fund manager, what are you doing? And your fund is just purely a dollar fund.
I think that if you are that guy, you're a fraud. You have no integrity. You shouldn't. That's not a real job.
Okay, so
No,
there
well,
is,
okay. No, I'll
in
tell you.
fact, a lot of-
No, but I'll answer that question.
yeah.
Because I think you're also living in a binary world, where because you're in dollar, you can't expose to non-dollar assets. There's a lot of synthetic ways or artificial ways of exposing yourself to non-dollar assets. It's exactly like how here in this country, in a Zim dollar economy, there's a lot of fund managers that are restricted to Zim dollar assets, but they're exposing themselves to US dollar risk without actually denominating themselves in US dollars.
There are lots of fund managers where it's actually very strict. And I'll tell you why.
Why would you take such a job though?
So no. I'll tell you the real benefits of taking such a job. And this is perhaps what you're missing, is that the most common denominated debt internationally, it's dollars. When the Chinese are buying US treasuries and buying dollars, they're not doing so because they're taking
but then the mandate, you're saying the mandate of the fund is debt.
No, the mandate of the fund is dollars. The mandate of the, so if I'm in Japan or if I'm in Zim and I have a US dollar debt.
Well, I get it. That your clients are hedging their dollar exposure.
Their dollar exposure.
Okay.
You have lots of fund managers like that internationally. And what they do is, right? And I'm saying in terms of trade. So there's the investment side and you're better at analyzing that. But there's at the trade level, when Japan is holding on to US treasury, why do you think they're doing so? When they're holding on to US dollars, why do you think they do so? It's got nothing to do with investment, but it has everything to do with their terms of trade with the US.
Or a lack of imagination.
Gentlemen, I think we have come to a suitable conclusion, and we have a meeting of minds. And the conclusion is this:
Less sugar for
less sugar for him, and he should wear pink pants more often.
Yes, I agree.
Have a lovely week. It's been lovely having you along, and please don't take us seriously. We don't know what we're talking about.